afternoon. We're delighted to welcome Octodec to Unlock the Stock today. This Unlock the Stock platform was created for retail investors to connect with corporate management and to get a better understanding of them and their companies. We are joined today by Octodec CEO Jeffrey Wapnick, Rian Erasmus, who is Deputy CEO and Financial Director, as well as Robert Gibson, who is City Property Administration's COO. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. Before we start, there are a few housekeeping notes. The company presentation will be followed by a Q&A session. As usual, the Q&A session will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address when we begin the Q&A session, and if you would like to be added to Octodec's investor distribution list, please take note of that email address. I am now ready for Octodec to share their presentation with us, and Jeffrey, for you to take us through that presentation, please.
We're ready. Good morning, ladies and gentlemen. First of all, I would like to thank Unlock the Stock for agreeing to host us on this webinar or podcast. Secondly, to all of you that have taken time out of your busy schedules to come watch and listen to this presentation, thank you very much. I sincerely hope that you get something from it. In doing this presentation, it is my first presentation. It is Octodec's first presentation. I had to give some thought as to how the format of this presentation, and I've been advised to rather do an anecdotal presentation rather than the kind of formal presentation that we do at our annual results presentation, as well as a 6 months half-year presentation. And that's the format I'm going to choose. Having said that, I'm also going to focus on something that I think is important for those of you that may be interested in Octodec, and that's spending a little bit of time on the CBD. For most of you, I guess, the CBD is regarded as a not such an investor-friendly place. I hope that I can throw other angles to you about why we're there in the first place. But it must be mentioned, and I'm going to mention it again, that roughly 50% of Octodec investment is in the CBD, and the rest elsewhere. But more of that a little bit later. So, Ilona, if I could prompt you to please move on. I think to understand Octodec, a little bit about the history, it is still, I guess one could call this a family business, and to an extent, it is run as a family business, and that has problems, but it also has a lot of benefits. It was started in 1956 by my late father, who started accumulating assets in the Pretoria CBD. Had he not started then, I don't think we would have had the time to accumulate such a portfolio within the CBD. Fortunately, I must say, he did that, and today we reap some of the benefits of that visionary foresight. Octodec itself, we're a thriving organization focused on with a focused portfolio, operating in Gauteng, South Africa's economic hub, investing in all the major sectors, namely retail, which we divide into high street shopping, as well as the traditional shopping center, residential, offices, as well as what's the one I haven't? It's high street shopping, normal shops. It's industrial. It's residential, as well as offices. Next, please. Here's the management team that I'm proud to present to you. With me, I'm joined by Rian Erasmus and Robert Gibson. The reason why I want this slide up here is not necessarily to recognize, but rather to tell you that we would be available at any time, and all of us enjoy doing this, to take any of you that choose to come visit the properties on a bit of a property tour, to view the properties. I think when you join us for a property tour, you gain much better insights into the portfolio. So please contact us directly or through, I think contact us directly through the company secretary, and we can set something up. Next, please. As previously mentioned, we are focused primarily in Gauteng, namely the city of Tshwane and the city of Johannesburg. One of the advantages of investing like this is we gain above average insights into our property market. It's not that we have to rely on staff that we hardly ever see, for example, located in Cape Town, or even more exaggerated when we have to rely on teams located elsewhere across the globe. Next, please. Here is a list of 10 of our bigger properties. And the reason why I'm putting this in here is that you can have a sense that when you look at them, hopefully these are thumbnail size pictures, you have a sense that these are not typical rundown CBD properties, which I suspect may be in your mind. But what follows from now is bigger pictures of some of our assets anyway. You can see the way that we've looked after them, we've taken care of them, we've upgraded them, and in some cases, greenfield type developments within the CBD of both Johannesburg and Pretoria. Elaine, if I can ask you to move to the next one, the next slide, and slowly but surely go through each one of these. I will come back to some of them and talk through them individually. Right. Thank you, Lana. I've asked Ilana to stop on this one. This is one of our most recent developments, and it is of interest to Octodec in the sense that Octodec, I think it's fair to say, has gone through a very quiet period, but now we are slowly but surely moving out of this period and moving into building the portfolio is starting to grow the portfolio at least. This has been funded in part by the sale of assets that we regarded as no longer having significance in the portfolio, and we're now starting to accumulate some firepower to start our development cycle. This is the most recent of such a thing. It's very interesting. It's a residential development. It's a pilot project in value of 50 million rand, where we took an old existing building, renovated it in what I would describe as being in a fairly innovative way. We don't supply the individual tenants a contained, self-contained flat, but rather we give them a room and supply with this room communal bathrooms, kitchens, and living spaces. This has proven by any measure to be an unresounding success, and we now would considering, well, in fact, it's been authorized by my board to produce more of these, roll them out. The next one is something called Capital Towers North, which will commence with construction fairly shortly. Next, please. I guess no presentation like this could be dealt with without some kind of performance highlights. And here we have one such thing. This is the 6 months ended 28 February 2026. Revenue starting to grow by 2.1%. Distributable income after tax increasing to 246 million rand. Dividend per share up to 64.5 cents, previously 62, a 4% increase in terms of the dividend per share. The payout, cash generated a total of 240 million rand, slightly down on the last corresponding period, and distributable income after tax an increase of 11%. Next, please. Salient features, some certain highlights, a fairly flat value of building. This must be taken with some context. In other words, we've been selling certain properties, admittedly not a lot of properties, but those that we have, well, let me put it differently. The properties that we have, in my mind, have been substantial, but the value of these transactions is relatively small. Typically, historically, Octodec comprises of a number of small buildings, but that's something which we'll talk about going forward. In other words, a movement to slightly larger assets that we have in the past. Loan to value, I'll come back to it, 37.3%, all in weighted cost of funding, 8.7%, core vacancies improving to 13.1%, borrowings at 4.3 billion rand, and total there we have the number 10 core properties. That's for the 6 months ended 89 million rand at an exit yield of about 7.6%. Next, please. I think that for an understanding of Octodec, this is a very important slide, wherein we give the split between the various sectors that we operate in. Residential at, call it 34%, retail street shops 22.9%, offices at 19.2%, retail shopping centers at 12.2%, industrials at 7%. There's a small amount there for parking. And I think that the next little pie chart there, where we split between Johannesburg and Tshwane or Pretoria, you can see that number that I referred to earlier on, with approximately 55% of our income coming out of Pretoria, outside the CBD, and the 46% coming from within the CBD. And there we've got the split between Johannesburg and Pretoria, roughly 30% in Johannesburg and 70% in Pretoria. Next slide, please. The portfolio. So I'm going to now go through the individual sectors and give some color into the kind of properties that we own here. First of all, residential. Residential, hard to describe using words. It's probably a site visit that would give you a better insight into these properties. But I want to say this to you. I'm a married man with 3 daughters. I would gladly spend some time staying at any one of these buildings should the need ever had to be that I had to stay in one of our buildings. I may choose not to stay in these buildings. These buildings in the main are located in the CBD. This is not where my community lives. And so I may choose not to stay there. But if the only consideration was the facilities available, I would certainly live within the CBD. I guess what I'm telling you, the level of security, the level of cleanliness, the level of organization and customer care that I would get from this building is would be sufficient for me to warrant bringing my family into staying into these buildings. Octodec was the first of the listed sectors to go into residential conversions. Yeah, and I think it's treated us quite well. Next, please. Shopping centers. A lot of people don't realize it, but our shopping centers, I think there are skills, although there are only 3 shopping centers, all of them trading exceptionally well. One in Waverley, one in Elders Park, and the other one, many of you may know, Woodmead Value Mart. Next, please. Street shops. These are the shops that are in the inner core of the city. And I think if you had to ask me a question, which streets would you want to be invested on, I would give you the exact location where the cross streets are on the main streets where one should be invested. And the previous team that ran this portfolio did well in choosing what I today consider the best retail locations within both the Johannesburg and the Pretoria CBD. Next, please. I'm of the belief that it's not property people, it's really that are smart, it's really the tenants. And there we present some of the tenants that are located both in the CBD as well as in the shopping centers. If the CBD had no attraction from any of these retailers, these guys are tough, they would not be there. Next, please. Here's another very important slide, in our opinion. Collections. We are collecting what we're billing, essentially. There are 1 or 2 years where we'll collect slightly below, but they'll be followed by 1 or 2 years where we collect slightly above. The last 6 months, collecting 98.5%. Next, please. Collections remaining strong. There I have some graphs which reflect over time the collections relative to the amount billed. Next, please. Financial performance. I don't want to go into this detail. The reason being, if you went into the Octodec website, all of this information is available. One of the advantages of Octodec is that the income statements are fairly simple and easy to understand. There are no cross-currency foreign exchange investments. It's all local. In fact, as previously mentioned, all based in Gauteng. Next, please. Like-for-like performance. I referred earlier on to the residential showing good increase, 5.7%. We've done well in residential. We anticipate more growth in residential. One of Octodec's assets is the fields, one of the residential student accommodation buildings. It's Octodec's biggest asset. To give you a little bit of color, I guess, and thinking behind it, I still think that South Africa, one of their problems is lack of affordable accommodation, and admittedly that one may argue that with high interest rates, high inflation, general lack of performance, lack of economic performance within the economy, our people of South Africa, it's true. But having said that, I certainly think that there are enough people left over that are bankable and that can certainly afford residential accommodation. The trick then, in our opinion, is to make sure that you get the lion's share of those bankable tenants. Retail street shops, done well, very stable. moving on to shopping centers. These are high performance assets that we've had in the Octodec portfolio. Office is an interesting one. We're showing a decrease in revenue, reason being that we've lost two major tenants in Capital Towers and Telco. But if you had to strip that out, we would be showing some growth. We are now investigating an interesting project, and that is a move in the CBD, taking our cellular offices and moving into the beauty industry, where we supply accommodation for the ladies who want their hair done, nails done, eyelashes, etc., etc. Enormous demand being experienced for this kind of investment. And industrial, we like it. Ours is different to distinguish it from typical other industrial. It's not the big box type assets that other people are bringing to the market. This is the smaller mini factories, which churn on a regular basis, admittedly, but we have the wherewithal, we have the people to handle, and systems to handle this. Next, please. Dividend policy, I think it's important to everybody. The funding of upgrades as well as the growth of the business, to an extent, must come from operations. I think in any business, it is wrong to do 100% payout, especially during times, and we're coming out of, especially during times of tough economic conditions. And when you're coming out of tough economic conditions, it is wrong to pay 100%. That's on the one side, but on the other side, we can't pay too little because we would lose our REIT status of a 75% payout ratio. We also want to maintain a healthy interest cover, and just to make myself clear, we have no intention of a distribution of less than 75%. We're in touch with many of our investors, and we do have to consider what the shareholders' expectations are with regards to dividend policies. The interim distribution of 64.5% last corresponding period was 62, which was paid in May 2026 and 2025 respectively. This year that we've paid, the 64.5 represents a 70% from the interim dividend, and will make up the 75% in our final distribution. Here we make the statement that the full year distribution will at least be 75.5% of distributable income per share. Next, please. Capital allocation. I think Octodec has to grow. There are areas that we've identified. I spoke very briefly about our preference for small industrial, big demand in both Johannesburg and Pretoria, specifically Johannesburg. We like resi in the sense that certain assets that we can't sell, there are certain assets that we can't sell, and to an extent, we can solve that problem by converting them. Our typical conversion style has been prohibitive in the past, but our new Yethu City is allowing us to convert buildings that previously, due to cost and rental constraints, preventing us from doing that. Disposal of Kalani Mall, that's a major deal in Octodec, still busy with the one or two issues, but there is just under 400 million sale that we announced in February 2026, earlier this year. And this will be applied in the near term to repay our debt, as well as in later months starting to invest in projects like Capital Towers North. Next, please. Gearing, we are fairly conservative. I think a portfolio of this nature could allow a far larger gearing ratio. But if you want to stay in the listed space, well, then you have to play to certain rules. But you can see with time, we are slowly but surely bringing our gearing ratio down to acceptable levels, from the 40 down to the 38.82. Next. Share price performance. You can see over time the share price is starting to recover. What the cause of this, they're numerous. Perhaps one of them, I don't know, will be the recent acquisition by Almira of a large percentage of 20-odd% of Octodec's issued share capital. How that's going to play out, I don't know. We haven't yet had the time to meet and have meaningful discussions yet. Next, please. An outlook. We are. You can read this, but my own personal feeling, I think Octodec is well positioned. I think that South Africa over the years has been changing, and Octodec plays to that change. Obviously, the macro environment being tough, but things are somehow have turned for Octodec despite the toughness of the economy, and we're starting to enjoy slightly easier times or slightly better revenues as a result thereof. We are executing with discipline. We're not going to be cowboys. Every investment that we make is very seriously considered before we make such a decision. But because of our knowledge of the area, because of our knowledge of our buildings with which we operate, we do have above average information that the management team considers. Execution and growth and strategy. I started talking about the execution of I want to talk about the execution of a 3-pillar diversified property portfolio that targets enhanced long-term returns. And I've mentioned where we think that there are opportunities. Once again, this is in residential, the lower end of the market, which we prefer to the high end of the market, the small industrial industrial portfolios, as well as shopping centers. Shopping centers is a difficult one because everybody out there is chasing them. So they're very competitive. The other two that we mentioned are not quite as competitive, and we think that there could be a gap there. Next, please. That you can read. I can't add much other than that which is written there. And next, please. Ilona, next, please. I think that this is the end of the presentation, as much as I want to say. I will now want to open the floor to Q&A, and looking forward to some meaningful questions that you, together with the rest of the management team, can ask us and we can discuss with you.
Thank you, Jeffrey, and to the team, and welcome to everyone. Thank you for joining this edition of Unlock the Stock. It's nice to have Octodec on here. Certainly a super unusual portfolio. It's not the stuff that we're used to seeing on the JSE, so it's cool to dig into this kind of stuff. I'm going to ask you something that I think is super topical and I think extremely valid. So obviously, potential social unrest coming up on 30 June. I mean, we've all seen it in the news. And there's a question in the chat here around how your portfolio is positioned for these kind of things. I mean, obviously, you're very reliant on the police, those sort of, the people who need to actually do this for their job. But unfortunately, your portfolio is in areas that tend to be hotspots. So, what is the history of the portfolio been with unrest? What are the plans for that day? I guess it just speaks to some of the risks of operating in these CBDs.
So,
Yes.
Rob, I'm going
Yeah.
to ask you to handle that, but I'd also like to venture one thought here. But have a go, Rob.
Yeah, so maybe just to start off, back in 2020, the June, July unrest, we were very fortunate in that we had very little in the way of damage to our buildings. We obviously took the necessary precautions to close down some of those buildings on the day when the rioters sort of got a bit too close for comfort. The damage that was sustained was one or two broken windows, but if you operate in the CBD, you might appreciate that that's like a daily occurrence, so it wasn't too much of an issue for us. We are aware of other players in the CBD that weren't as unscathed, and maybe we could put it down to our very established business in the CBD. So there is some ownership towards those buildings by the communities. People do live and work in those buildings. So we think that may have had something to play, a part to play in protecting them. We also have very well-established and well-practiced sort of business continuity programs within the business. We meet monthly. I mean, on this particular matter, we've been meeting more frequently. We've got guys on our teams with a very close ear on the ground, speaking to taxi associations, keeping very much in close contact with our security providers to utilize the intelligence that they gather to figure out how we approach the situation. But obviously we do err on the side of caution, and we have instructed our teams as and when necessary to put buildings on lockdown. Yeah, and I don't think there's too much more that one can do. Jeff, I don't know if you wanted to add anything to that.
Well, I think the one point, I think you mentioned it, Robert, and that is, I think we are proper community builders. We're well received by that community. And I think that the implication of that is that they help protect our buildings. Our building managers that are located are motivated. They're just a wonderful bunch of guys, and they know exactly what to do. We have very strong business continuity sessions on a monthly basis, and we regularly practice the shutdown. And yeah, we've done. I think I'm not worried in the sense that we've done what we can do. And it's really above average what we do to protect our properties.
Yeah, just echo what the guys said. Great to have the Octodec team on here for the first time. Question in my DMs around the discount to NAV, which they say is hovering about 30% thereabouts. Just a question on, I guess, why do you think the discount exists? We did see discounts, blow out right across the sector, kind of around COVID, post-COVID, but they've generally kind of come in for a lot of the other counters, and maybe some of the things you're thinking from a capital allocation point of view, buybacks, increasing the dividend payout ratio. Yeah, Jeff, you spoke to it in your presentation. Getting growth back into the portfolio to kind of attract people back to the stock because of some of the new things you're doing, like the Yetu City residential developments.
I'd like Rian to have a bash at that.
Yeah, sure. Thanks. Yeah, Mark. So I think to answer your question as to why there was this discount, I think like you correctly mentioned, I mean, the sector was trading at a discount in general. Of course, as the market came back, the larger counters were or their discounts were reduced first. And with Octodec, up until March, we weren't in the LP, if you will. So I think the large institutions then naturally don't invest in your stock. Since March, we've been included, so that attracts their attention. The big thing from our side is that we need to keep delivering. So delivering on performance, delivering on correct capital allocation, the asset or capital recycling. So rationalize our portfolio according to our strategy and sell the assets that no longer meet our investment requirements. But yeah, so with all of that together, that's the levers that we need to pull from our side to reduce that discount.
Maybe I can jump in and just ask about where we are in the cycle from a CBD perspective, a Gauteng perspective. I mean, a lot of people are talking about it at the moment. Where is the bottom for Gauteng? If we can put it as bluntly as that, I suppose. And specifically the CBDs, you guys have been in those regions for a long time. So you've seen, I would imagine, quite a lot of degradation, but maybe some signs that things are starting to get better recently. South African sentiment has certainly improved. We've seen a lot of positive stuff locally. We can even play soccer these days, which is quite exciting. So from a Gauteng cycle perspective, are you seeing those signs on the ground? I mean, you certainly really been at the coalface of some of the hard stuff. What happened with the Lillian Ngoyi issue and all of those sort of things, you know, are really difficult. Are you seeing positive signs on the ground in terms of how the place is actually run?
Yeah, so let me take this one. Yeah. I think it's a case of a tale of two cities. Where Joburg is concerned, I think there could potentially still be some room for further deterioration in service delivery. I mean, there we've done our very best to supplement the failing supply of council services, be it electricity or even water, you know, with the likes of generators, which we manage as efficiently as possible, and borehole waters and water storage facility to you know, provide our tenants with water when there are periods without water. So there, from a council perspective, I'm not seeing too much in the way of improvement. However, I am seeing significant involvement by the private sector in the inner city, and that's been a case for a while, but has intensified more recently in the last 2 years. So one way that we're involved is through the CIDs, the improvement districts. We have a number of them in the inner city, which we contribute towards. We're active members on those SIDs. So that helps to just, you know, keep things neat and tidy and improve the safety and security out on the street. And then in Johannesburg, more recently, there's the Josie My Josie movement. We are a member of that. And there the guys are really making a concerted effort on all fronts, be it street lighting, be it safety and security, just improving the urban environment, the paving, the marketing of the inner city, more recently with the 702 Walk the Talk actually happening within the inner city. So from a Joburg perspective, that's what's happening. I think the private sector is not leaving it to the city to sort out all the ills. They're having to step in and really, you know, play a part to keep things together. Where Pretoria is concerned, I think there is a much better picture. While it's true, you know, perhaps, you know, things look a little scruffy, you know, gardening is not maybe attended to by the council, or certain street lights that we're never out, are now out occasionally. It's definitely far more manageable. And we do have a far better relationship with the mayor and her team in the city of Tshwane. I think the scale of our investments in the inner city of Tshwane, the city does see us as a partner, you know, to promoting the inner city and to basically keeping it together. So I guess it's anyone's guess whether we've hit the very bottom, but if we haven't, I'd say we're very close to it. And I think there's too much riding on these inner cities to house, you know, the type of people that we house, the affordable housing that we offer, for the inner cities not to be improved. Yeah, that's my feeling.
I just want to add one thing. You know, We have had no option. Things get bad. We don't have the option to just throw away the keys and walk away. We've had to fight it, and it's brought out the very best in some of us, and we've brought out. I don't have the time to talk about some of the issues, but it's created for us. I guess a little bit of a war room, and in that group of things, it's how do we get water trucked to the buildings, running a fairly large portfolio of generators that are efficient, making sure that the power that these generators generate is properly managed, etc., etc. But there's something else, and I think it's brought out within our team a lot of innovation. Given the situation, how do we deal with it? Which I don't think would have been there had it not been for these tough times. If we can see a little bit of easing in the market, I think Octodec is very well positioned.
And Jeff, perhaps I could add just one more thing. I think in recent months, I'd say in the last 6 months, we've definitely seen an improvement in the rates of rental which we can achieve, especially in our office sector, which is a very difficult sector. So I think that speaks toward some sort of turn in the market, a turn in sentiment. And if one just looks at Year 2 City, one of our most recent projects, there we were able to achieve really good rentals and have a fully occupied building within a couple of months. So it means that despite all of these things happening, there is definitely still a demand by the public to be housed, to work, to have businesses within the areas in which we operate. So we need to supply that, and we need to supply it as efficiently and cost effectively as possible and give them a good product.
Yeah.
Another question here, and I don't know if Rian maybe wants to kick off with on the dividend payout ratio. What would lead to an increase in that? Is it linked to LTV and net income growth? Because again, I think we go back to the COVID times. There was a good few REITs that got burned who were paying out 100% or nearly 100%, and then COVID happened, and now we've heard from them that there's no going back to 100%. People are kind of trending more to around the 90%. So Octodec is a bit lower than the sector. So just there's a question in the DMs here around what would, I guess, lead to an increase in that, or is the money kind of being held back as part of this growth development push?
Yeah, I think so. We obviously looking at our portfolio and the capital requirements, on an annual basis when we go through this process of seeing what we need to do for the next year. And of course, in the longer term, we assess how much we need to retain. So, and of course, the maximum I can retain is 25%. In saying that, we've had this question in multiple presentations and from analysts. So for us, I think if you look at our strategic slide where we outline what our strategy is, we also mentioned there that for us to increase our payout ratio, we need to reduce our LTV on a sustainable basis to 35% and below. But importantly, it's also the interest cover ratio leg of it. I think sometimes because we're a property company, people get stuck with the LTV side of things. But for our ICR, that needs to operate at a 2.5 times minimum for us to consider increasing that payout ratio. So that's the objective for us, regardless of the payout ratio. But that is, if we get there, then we can look at increasing it. In saying that, of course, if there's no capital projects that need the retained income portion that we keep, then of course we can increase the payout ratio. But I think the maximum, as you've said, is probably never going to exceed the 90% levels.
If I can just jump in before the finance costs, so we just stick to the debt ones again. I think there was a slide in there from Jeff about how the debt LTV has been like trending down. So one question is around kind of what is the kind of target you're aiming for, and then there's another question around some of the recent refinancing has been coming in at better margins, better rates, and should we expect that to continue over the next 2-3 years as kind of maturities just naturally roll off and you're back into that refinancing? So a kind of a two-part question, Rian, and Jeff or Rob, jump in if you want to.
Rian,
Yeah,
you're the treasury man.
Yeah. So, I mean, yeah, like I said, so for us, I don't think we are concerned about the amount of the debt. It's rather the LTV ratio and the ICR. So, LTV needs to get to 35%, ICR to 2.5 times. That is our objective. In terms of the refinances, it's gone very well over the last couple of years. We've improved the margins and we continue to do so. And I think with all the maturities coming up, I think there's definitely improvement that we expect in those margins, but it has to be backed up with performance as well. So as we continue with our strategy that we agreed with the board last year, as we continue to roll that out, and of course, which means we're rationalizing the portfolio, we're focusing on specific sectors, we should improve the performance relative to or comparing to the previous period. So with that supporting our credit metrics, we should see an improvement in the margins.
Let me jump back in here. I was interested in a comment actually in your recent financials where you talked about asset disposals were essentially earnings neutral due to the high interest rates in South Africa, which obviously is something that everyone struggles with. We do have these structurally high rates and the SARB loves putting them up and not so keen to always bring them down. Obviously, the areas that you have your portfolio in are also not exactly capital growth world champions. Unfortunately, you haven't had that sort of boost that the Western Cape funds have had and that kind of thing. So you've got all these different levers to pull, but it does feel like a lot of external factors make it very difficult. As people try to understand what the catalyst for upside could be, just one or two of those macro things or things that you wish would change just a little bit. If someone's waiting to hit the buy button on Octodec, what should they be looking for from either a macro perspective or an underlying thing? What would get you the most excited and give you the biggest boost in your business that is outside of your control?
Yeah, I think, sure, outside of our control is definitely, there's two things. I mean, we're a property business, so one of our biggest source of capital is debt. So I think it will help if the SARB can reduce the interest rate a bit. And take into account the economic state of South Africa. I mean, yes, we recognize that inflation needs to be managed, but I think at the same time, sometimes we forget that generally the consumer and the small businesses are under pressure, and I suppose as a consequence, the larger businesses will also come under pressure. So, and then the second part is I think we need South Africa to grow. I think if government can deliver the services it should in all the councils, and particularly in Gauteng, which is the heart of the South African economy, that will definitely be a big boost to Octodec.
Can I just make one comment, and it relates to an early comment, and that was a negative perspective of this market. And I want to reference you guys to what happened at Capitec Bank. I mean, the big banks turned their back on this market. They thought this wasn't bankable. The big banks were wrong, Capitec were right. And there's an element of that within Octodec, but to agree with Rian's sentiment, a small uptick in improvement in the economy will make a big difference to Octodec.
And maybe a kind of a slight follow on in that theme. And yeah, Rian, we won't get into the SARB. I could have a long conversation with you on they never seem to distinguish the type of inflation between demand pull inflation, cost plus inflation. And I think they just look at it as one uniform number where there's very little demand pull inflation, I think, from consumers and small business, which they don't seem to focus on at all, but I digress. I want to just talk about office for a second, and it's linked to this, getting a bit of growth. Office has been a thorn in the side for, a lot of counters on the JSE, especially in Gauteng. But I want to understand, and you probably know the market better than anyone, is it chronic oversupply from overbuilding that happened historically? Or would, if we got a decent bit of growth and an improvement in sentiment, let's say, post the local elections in November, going into 27, 28, would a bit of growth, somewhere around the 3% level, would that really fill up offices? Or even with a bit of growth, there's literally that much supply where these buildings need to be reimagined, repurposed into something else? I'm just trying to get a handle on, is it massive oversupply that, even with demand, it's not going to soak it all up? Or is it we just need a bit of growth, especially in Gauteng, and that would quickly translate into office vacancies and improve rental revisions and reversions kind of coming back in line?
So if I could comment there, and that is the Octodec portfolio is not we call it offices, but it's not your traditional office. In the sense that roughly 50% of the office portfolio is inner city stuff, and it's occupied by government. Government is a very tricky beast to handle, but somehow we get through it. The other 50% is the interesting one, and that was, it's no corporate is going to move back into the CBD, and we don't see the South African corporate moving back there for traditional uses. But what we are seeing, and this is what I spent, I don't know, well, I did it, but some time talking about, I think that those that use the CBD are now realizing that they can't rely on the CBD, can't rely on corporate to provide jobs. They have to now find their own way. And we are starting to see quite a nice fall off of vacancies within the CBD. So these are little startups that we haven't seen for a long time. And I think it's because people just can't get jobs. And what must they do? So now they're forced into a situation where they are looking for jobs. Some of them are in traditional users. So you'll find we got the courts in Pretoria. So you'll find a lot of lawyers starting to come into the CBD. I mentioned beauty. I think that is big. And just some, you have to see it to understand it. Things like driving schools, things like tailors, things like dressmakers. They are filling up that market quite nicely. Whether it's going to materially move Octodec's distribution, I don't know, but certainly there is growth happening there. I can't comment on the traditional stuff because we don't have that.
But Jeff, maybe I just make the point that our business has been built on the capital flight out of the CBDs. So many of our residential buildings that we developed many years ago were for that exact same reason. There was an oversupply of office space in areas where there was not as much demand for that office space. And I'd say that even with some growth in the economy, we're still going to be sitting with an oversupply. I think in the 2010s, there was a gut of development, if one just thinks of in the Sandton and Rosebank areas and a whole bunch of other areas. So, when the corporates that Jeff refers to are looking to set up an office, they've got many choices. So I think ours, not to sit on the fence, but I think it's a bit of both, an improvement in the economy and an improvement in the way the cities run will fill up a lot more space, but it will not fill up all the space. You know, there are pockets in the inner city that have been vacant for 30 or 40 years. You know, so that's for how long there hasn't been demand for those pockets. But and there are redevelopment opportunities, and we see numerous players, especially weirdly enough in the Johannesburg CBD, taking up those opportunities to convert those buildings to resi, where there is still a very strong demand.
Perhaps I can jump in with one more from my side at least, which would just be around your indicators that a property would be non-core. So I think you've made the really good point there that a lot of this stuff was bought up when there was a flight of capital. So you were the exit liquidity when there wasn't much of that, which makes sense. You know, it's buying low and it's been willing to hold through the cycle. And obviously Amir has seen value there, which I know is something you probably can't talk about, but I mean, it's interesting to see. So in terms of how you would look at a property as non-core, where you make the decision to say, actually, we can't keep holding this thing, what informs that decision? And then other than the easy, if I say easy, properties to get rid of, there are obviously some that are easier than others. To what extent are there exits available to you for some of this inner city stuff? Or is there still a complete lack of capital in the market to actually give you that exit?
I don't know. You want to try to answer that one, Riaan?
Sure. Yeah. Yeah. So I think, you know, when we look at our portfolio, when we decide as to whether we want to remain invested or exit an asset, you know, it's I think it's first and foremost is performance. So, you know, if we see that a property is approaching its, call it ex-growth position, if you will, in both rental income, whether if we can't grow the rental income, you look at whether can you drive efficiencies in the costs. So in both instances, if we can't achieve that, then we obviously we see this property as an ex-growth asset, and we will then classify it as a non-core. I think the second part for us is that, you know, if the asset is no longer located, we would like to be invested. So, like for example, in Pretoria, we identified Pretoria West as an area that we no longer wish to be invested in, simply because, well, the dynamics of the tenants have changed, and of course, council is no longer servicing the area appropriately to the extent that we can step in and service our properties the way we would like to. Then we would make that decision to exit the location and of course the asset. And then I think the third item we look at is how big is the asset in terms of or relative to our portfolio. So we have a number of assets now, as we're going through the rationalization of our portfolio, that is sitting at the below 10 million rand levels. So basically between 10 and even up to 25 million rand levels, if though we are strategically looking at those assets and saying, you know, hang on a moment, this is taking too much management time, regardless of how well the property is performing. So then we would that's one of the indicators for us to exit. In terms of whether there is demand, well, I think in the last 18 months we've sold 28 properties, and most of them are at these levels, and most of them are in the locations that we no longer wish to be invested. So there is definitely demand. I think the thing that we need to take cognizance of as management and as the market is that in a lot of these instances, we will have to take. Oh, sorry about that. We would have to possibly take a haircut and sell these assets at a discount. But yeah, there is definitely demand. It's the price drives a lot of the acquisitions or disposals.
I would just like to support Riaan on one point, in that don't underestimate the benefit of working with property close by. and having regular daily leasing meetings. We know exactly where the demand is coming from and where it's not. And certainly within the CBD, we know where there are pockets of strong demand and where there are pockets of weak demand. And where it is the weak demand, we know that shouldn't be part of the part of the deal. They say talk about location, but they don't always tell you one thing, and that is location sometimes changes. And so we're on top of that. Maybe it can be accused of not moving as quickly as we should have, but we're moving now.
Well, thank you, Jeffrey, and thank you to everyone who joined us and chose to spend time with us today. And a special thanks again to Jeffrey, to Rian, and to Robert for making the time to support the platform and to engage with retail investors. Our next session of Unlock the Stock will be on Thursday, the 9th of July, and we're going to be pleased to be welcoming back to Unlock the Stock Orion Minerals. So thanks to everyone who joined us, and that is all from our side. Goodbye.